Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest and one of my most favorite guests, also requested a lot. She is the author of Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better back in 2023. The book is available on Audible audiobook, paperback, hardcover, on Amazon, and also through the other crypto websites. I think she also just started a free market speech website in the that's competing with some of the other censored social media ones out there, and is one of the top global macro experts. Lyn Alden, thank you for joining me again.
Happy to talk. It's been a while.
Yes, you're so busy with booking your interview schedules. It's tough to get you on.
Well, I've been in Egypt, and the problem is that in Egypt they don't have very strong internet, and so I generally don't schedule very many appearances while I'm there. And so my schedule was kind of difficult the last few months, more than normal.
You need to talk to Elon Musk and get one of your personal like VPN satellites or something.
Yeah, I'd like to see Starlink operational there.
Oh, well, maybe he'll be listening to this podcast. So, we're recording this interview on Wednesday, January 22nd, 2025. The Bitcoin price has been on fire the last couple months, really strong rally. I think it hit around 109,000 a couple days ago, and it's back down a little bit to 104,000, but it's been trending up with Trump making commitments to the Bitcoin crowd. The gold price has also started to rally along with the dollar. Kind of weird in this environment. The gold price is at $2,750, a little bit above that when we're recording this interview. I want to get your thoughts, though, since your position, Lyn, as a Bitcoin investor, you own investments in some of the Bitcoin blockchain companies that are doing the innovations with blockchain technology, Lightning Network, besides just Bitcoin, on the energy requirements going forward for Bitcoin mining and next generation data centers for artificial intelligence. Are we looking at a bottleneck, huge problems, and also investing opportunities because of Bitcoin mining and because of these data centers?
I think there's more opportunities than bottlenecks. I think over time, Bitcoin mining is going to move more toward the periphery, either in terms of location or time. And what I mean by that is that so Bitcoin mining is one of the more flexible things that people can do with electricity because they can turn it off on a dime without too much disruption. You can't really do that with other types of businesses that have tons of overhead. With Bitcoin miners, electricity is the vast majority of their cost, and they otherwise run pretty light, so they can turn it off. So they have flexibility in terms of time. They also don't need much bandwidth. So anywhere you can have a remote connection, including Starlink, you can run Bitcoin mining. So they can go out to stranded, gas wells and things like that, and stranded hydro and all sorts of projects like that to fill the void. Um, and so I think over time, Bitcoin mining will primarily be used for demand response. So it basically soak up excess electricity um, outside of peak hours, or it'll be on the periphery in terms of location, in terms of going after stranded energy sources. Because the ultimate competition in Bitcoin mining is that they need super low electricity costs, especially outside of some major bull market. So if they're operating structurally, they need very low electricity costs, and so they get pushed away from population centers. And between the two, I think they'll get pushed away by AI data centers because AI data centers they invest a lot more in capex. Their chips are a lot more expensive. Electricity is a smaller share of their costs, and they can generally outbid Bitcoin miners for electricity. Um, but the trade-off is that they're less flexible. They don't like to turn off as much because, CapEx is such a big part of their investment. Um, their customers expect reliable services, and they also generally want to minimize latency, so they don't want to be too far from population centers. And so altogether, they have higher uptime needs, higher bandwidth needs, and less flexibility turning off. So I think they're going to be kind of the main drivers of spare energy in the US. Um, and if anything, they can, some people were concerned around Bitcoin miners competing with consumers for electricity. And that's not really the case because like, again, they get driven to the periphery. But ironically, AI is kind of in that bucket where it could compete with other businesses and homeowners. And so that'll be an interesting dynamic. I think in the US, we're probably going to have a lot of natural gas power that. But I do think we'll see more and more Yeah, I think that AI data center investing is going to be a big long-term trend. Um, and around the margins, I also think that Bitcoin mining will be an important trend. Uh, some extent in the US, but also elsewhere, including in places where AI data centers are not super sustainable.
So do you think then, as the Bitcoin price keeps going up, it becomes harder and harder to prove to verify the blockchain with the halving, the harder math problems, that more energy and electricity are required, that this is going to also increase electricity demand along with artificial intelligence and data centers? Do you see like potentially like a 10x move in electricity demand usage here in the United States or globally over the next, let's say, 2035 in the next decade?
So I don't think that Bitcoin's going to 10x in electricity consumption because um, so they have a difficulty adjustment. So whenever new miners come onto the network, difficulty gets harder. Whenever miners leave the network, maybe because it becomes unprofitable in certain regions, then the difficulty goes down. Um, I think it will consume more electricity in 10 years than it is now, but not by 10x. Um, in addition, the block subsidy decreases every 4 years, and so it transitions more toward transaction fees, in terms of paying for it. So partially will depend on Bitcoin market capitalization and Bitcoin volumes. That'll determine kind of the maximum uh, of the size of the Bitcoin mining industry and therefore its electricity consumption. I continue to view that it'll be like a rounding error in terms of global electricity production. Um, it'll be, always big figures, like, consumes more electricity than the state of New Jersey or something like that. But in the global scale, it'll be just like any other reasonably large industry in the sense that it's a fairly small piece. Um, I think AI is going to, 10x. It's very computationally energy intensive, and as long as the productivity keeps increasing, and the more tasks we can apply it to, um, practically every company in the world is going to want to be using AI to some extent. Every consumer is going to be wanting to use AI to some extent. And unlike the tech growth of the 2010s and recently, which is mostly social media and mobile internet, all of that was not very energy intensive, not very computationally intensive, and if anything, like for example, the fact that we can use our smartphone for like everything now reduced our need for other material intensive and energy intensive things. Like fewer people need printers or scanners because they have their phone. Fewer people need, they don't use as much stationery as they used to because they have their phone and so on and so forth. Um, and whereas this tech wave is going to be more computationally intensive and therefore more energy intensive. Um, and I think that's going to be a trend that's going to persist for 5, 10 years and potentially more.
Yeah, I think that's an important point that you brought up in the last couple of minutes with the next generation data centers. They need stable baseload electricity, whereas the Bitcoin miners, I think you were going into detail about how they could stop Bitcoin mining, and then what the Bitcoin algorithm will adjust to that if less miners start mining or the electricity prices go up. I think you said the math problems get easier to solve. The artificial intelligence companies, the ones that are running the LLM software, they also have cloud computing businesses. So like Microsoft and Amazon, they're investing heavily into capital expenditure for their cloud computing businesses. It's like a dual purpose. So when they build a data center, they can justify it with their cloud computing business, but also their artificial intelligence investments as well. So I think that's why you're seeing a lot of these companies come in. I mean, the capex numbers, Lynn, have you ever seen anything like this? What Microsoft committing $80 billion in 2025? I don't know if they'll actually spend it, but they're at least saying they're going to. And then Amazon's committing even more than that.
Yeah, it's enormous. And Microsoft, I mean, they plan to recoup some of the cost by being able to increase, their subscription fees for like Microsoft Office because they can incorporate more and more AI tools, into their existing products. I think we'll see more of that over time. And, there could be periods of time where CapEx gets a little bit ahead of itself. And then you go through a little bit of a shedding of, a little bit pockets of malinvestment or, you know, investment that was too front run. Um, but I think looking back 10 years from now, a lot of this investment will be justified. And we'll be spending a bigger share of our money on computation 10 years from now than we are now. And it still will probably be a fairly small share, but it'll be up from, whatever percentage we spend now.
So, do you think then the way to play this trend as an investor is probably through the infrastructure and the energy and electricity demand? So, like electrical utility companies are going to have to make investments into the electrical grid, into expanding power utility stations, nuclear power plants, uranium demand, natural gas demand. You think that these are going to be the opportunities rather than betting on which artificial intelligence software company is making innovations?
Yeah, I think that AI companies themselves might have trouble accruing value. I mean, ChatGPT was one of the most successful launches ever, and for example, they're still not profitable. Um, and so I think that some of the value will accumulate to the hyperscalers. Um, there are and will continue to be open source AI models. And so it's hard to stay super ahead of the competition. And then all the indirect ways. So all the electrical stuff. I mean, the downside of the electrical investment argument is that a lot of those companies have already gone parabolic. So a lot of the producers of electric parts that utilities would buy from are already backlogged, and already trading at pretty high valuations. So it's something that a lot of investors have already figured out. Um, but in general, I think there's a lot of opportunity still. I think that in the US, natural gas is an interesting opportunity because, natural gas in terms of like energy density trades at a discount to oil in the US. And I think that natural gas is going to be one of the major energy sources for a lot of these data centers. Um, and so I think that companies that transport it, companies that produce it, are generally going to be pretty well positioned in the years ahead.
I think there's going to be a natural gas boom for demand, liquefied natural gas export boom. I think the Trump administration and Republican controlled Congress, we're going to get more natural gas pipelines approved from like the Permian Basin or the Marcellus and Utica Shale in West Virginia and Pennsylvania down here to the data centers in Northern Virginia, or the Permian Basin, the natural gas production there in the shale oil, that's a byproduct. It'll get to the liquefied natural gas export facilities that will probably be fast tracked or approved more with the permitting going forward over at least for the next 4 years.
Yeah, I think so. And I think long term, uranium's also a decent bet because I think nuclear power can fuel some of this, especially outside of the US. And so I think that any energy dense source that is not very highly priced is primed to benefit. And in the US, the current kind of arbitrage is that you get more energy per price of natural gas than oil because historically the exports have been somewhat constrained, either from pipeline limitations or LNG capacity limitations. And so you'll see way higher prices in Europe than in the United States, for example. And over time, I think that will close either from exports increasing or using that natural gas more for data centers, or in some cases, using it more for transportation. Like, certain vehicles can substitute for natural gas to save money. And so I think all of that over time improves the price prospects of natural gas and any company that's associated with the production or the transport of it.
So I want to transition now to like these meme coins like Fart Coin and Trump meme coin, and I think Melania meme coin is going to launch soon. Do you think how are these things different than Bitcoin? And do you think that like this type of fad, like whether it's initial coin offerings, NFTs, meme coins, are these bad for Bitcoin? Because these could potentially turn into pump and dump scams. The SEC can't investigate thousands of pump and dump websites or Telegram groups. How are these things different than Bitcoin? And do you think that these things are bad for Bitcoin?
I think they can temporarily get in Bitcoin's way, but I don't view them as long-term bad for Bitcoin. It's a similar way that like no matter how many pesos Argentina prints, it doesn't really affect the dollar. Um, and it's kind of like that with cryptocurrencies and Bitcoin, which is one of the early fears that people had, including myself, when analyzing the space is, maybe Bitcoin's scarce, but anyone can spin up a new cryptocurrency. And so the space as a whole isn't necessarily scarce. But that's where network effects and security models matter. And so, the Trump coin is just a meme coin built on top of Solana. So you have various layers of centralization Um, there's no real guarantee that the supply cap is going to be what it is. And then even if it is, it's just one meme coin. It happens to be a particularly big one because it's Trump, but it's one meme coin among many, and there's no barrier of entry into making them. Whereas Bitcoin, one of the best ways to think about it is, like USB, right? That's been around for 25, 30 years. It's on almost every device that matters. Um, and it updates over time. So you have USB 1, you have USB 2.0, USB 3.0, and it's a self-sustaining network effect that's very hard to disrupt. Same thing with Ethernet, same thing with simple mail transfer protocol. Uh, these types of technologies, once they hit network effects, become very self-sustaining. Bitcoin has by far the leading liquidity among cryptocurrencies. And then the way that the mining works combined with the small node size means it has by far the most nodes in the world, and nodes are what enforce the supply cap. Um, and so it's the most difficult network to censor. Um, it's the one that's kind of the most robust, most resistant to attacks, the fewest security assumptions on the full stack compared to, say, a meme coin trading on another blockchain. Um, and so, to some extent, it kind of sucks value away from other things. I think mostly what we've seen is the meme coin sucked things out of other cryptocurrencies other than Bitcoin. Um, and so, for example, one of the losers of this has been Ethereum because Solana is the blockchain capturing, a lot of the meme action at the current time, and Ethereum's kind of like stuck in the middle. It's kind of like in retail. You either want to be a luxury retailer or you want to be the cheapest retailer. You don't want to be in the middle. So we can kind of think of Bitcoin as like the super high quality one, and then something like Solana is trying to scale as much as possible and keep transaction fees as low as possible, and Ethereum's kind of stuck in the middle. So it's certainly every new cryptocurrency or any new meme sucks value away from others, but not necessarily Bitcoin. And so, for example, we've seen very little price impact on Bitcoin in response to all this meme activity. And then over time, DeFi was popular for a while and then kind of, it's still active, but it kind of stagnated. And then NFTs were very popular, but then they flooded the market with just countless NFTs. And so that stagnated. And I think we'll see the same thing with this meme cycle, is that eventually people will be exhausted by meme coin dynamics. And it doesn't mean it'll go away. It just will kind of reach some level, and then kind of like the whole GameStop craze, the Wall Street bets craze will eventually just kind of grow old.
Well, also on social media, I mean, there's people actively promoting, like trying to pump and dump some of these meme coins. So I think there's so much of that going on right now, whether it's an Instagram model reading off a script that her boyfriend or handler or business manager gave her, or people with like burner accounts on X, like saying like which meme coin should we pump next? I mean, like there's just too many of these things for the Securities and Exchange Commission to bust.
Yeah, I mean, I'd still advise caution for people doing it because you never know if you're going to be the one that they bust or what the rules are even going to be. But yeah, basically, this is an example of so technologies reduce the gatekeeping and other things. Like I mean, this podcast exists because we don't need to rely on radio anymore to have audio or visual shows. Self-publishing went around the traditional publishing gatekeepers for books and other blogs and things like that. And this technology basically goes around the SEC for security issuance. Um, and just like self-published books, the vast majority are going to be low quality. Um, and so it ends up becoming a very kind of like, insiders, pump and dumps, really dangerous for retail investors. And then eventually, I think retail investors will increasingly grow aware of that. I think the ongoing cycles in cryptocurrency have rightfully made them very wary of a lot of these projects. Um, and that's why I think it'll hit kind of a ceiling and then just become uninteresting. And it'll be like, it's sports betting is a thing, and this will be an online casino thing that people can do, but it's going to have, I think, its reach limited, just because it's not a very healthy market.
Well, I think it's because of the culture with the Instagram lifestyle. People see that, and YOLO, you only live once, FOMO, fear of missing out, that so many people are just trying to get rich quick. They don't have a lot of capital accumulation and savings. They don't have hundreds of thousands of dollars to go buy dividend stocks or rental properties. So they have like a couple $1,000 or 5,000 or 10,000 or 20,000. They're trying to gamble with that to multiply that quickly to try to get rich quick. But then this is what you just see this now with all the sports betting apps. People are betting like crazy on fantasy sports now on their phone, or sports betting on their phone inside the game, inside in prop bets, all this stuff. Like, I don't know if you've seen this. There were articles on, I think there was a new article in the last couple of weeks that American culture is now turned into one big giant casino, including betting on elections.
Yeah, and I think that that trend continues until it doesn't. I think part of that is the fiscal environment, the debasement environment that we're in. Historically, when you have rapid currency debasement, you have an increase in speculation. And then in this case, if you have other factors like one you mentioned, I mean, people, there's social media comparisons and other things like that that kind of incentivize people to take more moonshots. I think eventually that kind of reaches an apex, and then the cool thing becomes not to do that. And it's hard to judge exactly when that happens, but you know, it's generally speaking, cryptocurrency narratives will get more like less sophisticated over time. So you went from ICOs to DeFi to NFTs to just memes. So in the prior cycle, they were also basically pump and dump. So in traditional venture capital, founders and early investors lock up capital, and their fortunes are pretty much tied up for 5, 7 years or longer, and they're only going to make money if the company itself is sustainable that long and either is good enough to go public, including through all sorts of SEC scrutiny, or they're good enough to get bought by another company that's like putting serious money to work. Um, Whereas crypto VCs, they separated the financial incentives from the outcome of the project, which is they would have like 2 year lockups, and founders and early crypto VCs can get rich and walk away and sell to retail um, before they've built anything of durable value. And they would always describe as, oh, this is the next big thing in tech, and all the assets are going to run on this thing, and like this is the future. And then those projects would stagnate, and memes just kind of cuts to the chase and says, no, there's no product here. We're just all gambling, and we're going to see kind of who gets left holding the bag. So it's ironically a little bit more transparent, but also um, there's a ceiling on how interesting that can be to people, because eventually their heuristics change, and they start associating these things with losing money, and therefore they kind of get relegated to a niche market.
Yeah, it's even worse than the internet stocks in pre 2000, so 1999, the
Yeah.
technology bubble. And those companies, I was saying they were pre revenue. So they're advertising, oh, we're getting clicks. Oh, we have a website. Oh, we're getting clicks, but we're pre revenue. So like it's even worse than that.
Yep, pretty much.
Well, I think a lot of the capital that may have went into some of the commodity stocks for an inflation hedge. So some of these gold stocks, there's profitable gold companies like Agnico Eagle that has two low-cost gold producing mines. There's oil companies, the oil price is starting to rally and hedge here, or natural gas opportunities. So there's a lot of cheap valuations in the commodity space. So I think the commodity space has gotten like negative sentiment. Capital that may have went in there and safer for dividend place has been chasing crypto or some of these meme stocks trying to get rich quick.
I think so. I think some people have said that Bitcoin competes with gold, but so far the only evidence I've seen is that so if you're like a hard money enthusiast, one option is to own gold. That's the low volatility, highly liquid play. But then all the other ones are higher volatility. So owning silver, owning platinum, owning gold miners, especially small caps, silver miners, those are considered higher volatility plays associated with hard money. And Bitcoin and to some extent the broader crypto space competes with that, the high vol hard money interests. Um, and so I do think that that has eaten into some of the interest in that space, potentially some of the small cap commodity producers as well. Um, Whereas probably the bigger cap commodity producers and energy producers, they probably just had their lunch eaten by Mag 7 and growth companies. So that's a different pool of capital. But yeah, general valuations are not that high. And then especially in the energy sector, there's generally been a strengthening of balance sheets and companies returning capital to shareholders, being more disciplined in production, um, and buying back shares, and whatever the case may be.
But in the GDX, which is the gold miners index there, I think the high was 2011, and the GDX is down almost 50% from the 2011 highs, and yet the gold price, I think, it was around $2,000 back in 2011. It briefly hit 2,000, but here we are, we're over 2,700. But the gold stocks are priced as if the gold price is around $1,000 an ounce less than that. The gold miners' valuations are just incredibly discounted compared to the gold price.
Yeah, and I mean, also a lot of them have diluted their shares. So a lot of some of them have better earnings per share than they had back in 2011, but other ones don't. Their costs on average are, kind of sticky. Um, and so it really comes down to individual miners. I think that generally with like high stock to flow value accrual types of commodities, which is only a few, like, gold, silver, uranium, um, the commodity tends to outperform the producers over the long run, unless you're like in the top 10% of skillful producers that consistently create value. I think Bitcoin miners are going to be in the same bucket, which is over the course of 10, 20 years, I think most Bitcoin miners are going to underperform Bitcoin. And, the top 10% that really know what they're doing and that they're investing counter-cyclically and, all that stuff, they'll outperform. But in general, the safest play is just to own the underlying.
Yeah, I mean, unless you're a royalty and streaming company, so like Wheaton Precious Metals, there's only
Yeah.
about five gold stocks, I think, since like 2010 that have done very, very well, and three out of the five are precious metal royalty and streaming companies.
Yeah, exactly.
So I want to ask you about the macro situation. I know you study financial history. We have the 10-year US Treasury yields and other government bond yields in the G7 starting to rise substantially despite the central banks cutting rates on the front end. We have a relatively strong dollar. We have rallies in the Bitcoin and gold price, a mix of kind of the safety trade and also risk on cross currents. Have you ever seen anything like this in financial history when you've looked back in the 1970s stagflation or the 1940s that you often cite?
Well, the 1940s would be the closest. The difference is that they did yield curve control. So I think you would have seen this in the 40s had they not done that. So this is kind of like what you get if you run the 40s without yield curve control, at least so far. Um, and so, the phrase I've been using, I didn't invent it, but I've been using it a lot, is fiscal dominance. So this is kind of the first time in investors' lifetimes where the developed world is in fiscal dominance, including Japan, the United States, to some extent Europe, but especially Japan and the United States. Um, and historically, you only see that in certain emerging markets recently, or if you want to look at it in developed markets, you have to go back to the 1940s. Um, Now, I don't think the rise in yields is that surprising, given that, a lot of them had inverted yield curves for a long time. And when the market starts to realize 7% a year deficits are not going away anytime soon, um, that maybe this is going to run hotter than they thought. Maybe they shouldn't keep betting for a recession. Um, and that so even when the Fed cuts the short end, they still want to get paid for the long end to take on all that volatility risk, um, while all this fire hose of supply is coming. And so it's not that surprising that they've risen to some extent. If you start to see yields going over 6%, I'd consider that surprising. But right now, I think a uninversion of the yield curve is a natural state of affairs.
Do you think that this is a very long-term government bond bear market, especially for the longer duration government bonds?
I think so. I think the nominal downside returns I think are mostly behind us. Like I don't think we're gonna like smoothly start going the 10-year up to like, 6, 7, 8, 9, 10% or anything like that, at least any sort of like near term. But I think in like real terms, um, it's a much less attractive market. So for 40 years when you had declining yields, and they started from pretty high real yields, you get a lot of interest and also you get capital appreciation. And now, even if they just chop around, let's say yields fluctuate between 3 and 5% for the next decade, or 3 and 6% for the next decade, um, you're getting paid that and you're not really getting any capital appreciation other than if you're a trader and you're kind of, buying the ebbs and flows. And so I kind of, that's my base case is, okay, so the worst of the returns are behind us in bond land. And then now it's just kind of lackluster returns, especially in inflation adjusted terms, um, which limits their attractiveness compared to scarcer assets.
In the 1940s, did the dollar also rise relative to other currencies while the bond yields were spiking, or is this kind of something that we haven't seen before?
Well, so back then, most currencies were pegged to gold, and then the 40s, the late 40s, with the mid 40s, were also the start of the Bretton Woods system, where currencies pegged themselves to the dollar, and then they also had tons of capital controls. So even the Bretton Woods system didn't actually really start until the late 1950s, because that's when they started lifting some of these curtailments. And so that's not a great comparison to do. Basically, in the 30s, there were different levels of currency devaluation that countries did relative to gold. They all, they broke their gold pegs and revalued them. Um, but yeah, the 1940s was just a different environment. So I think that the way you can look at it is to compare, what did real estate do in the 40s? In the US, real estate soared in price and hit a high plateau and then stayed there for a while. Never came back down, but it just kind of like then chopped along for a while. And so you had a big devaluation of the dollar relative to real estate. Um, and it would have devalued versus gold if it wasn't, pegged and then gold made illegal. So that kind of all came out decades later in the 1970s. That's why that pent up change was so explosive. And it eventually came out in other commodities. So when you look at the dollar and other currencies relative to scarce assets and equities, that's mostly where it showed up. Is basically anything scarcer than currencies generally did pretty well, unless it was explicitly pegged or pushed away somehow.
There's a lot of cross currents right now because you see some risk off behavior with the dollar strengthening on the dollar index and then also the gold price. Do you think that the gold price strengthening, I don't think the demand's coming from American retail investors. Do you think more of the demand side is coming from the marginal demand increases are from Asian retail investors in what, China, India, Japan, Korea, Thailand? Because those currencies have been relatively weak against the dollar for the last 18 months.
Mostly, yeah, it's coming from sovereign buyers that have been pretty healthy buyers, and then it's coming from retail outside of the U.S. If you're imagining yourself as a Chinese investor right now, um, real estate prices have been deflating from a very bubble valuation level, and at the same time, the stock market's not been doing very well. Um, and so where would you invest? Precious metals are one of the options, and it's for them, it's one of the more socially acceptable options. Some of them invest in Bitcoin and things like that too, but of course it's a smaller market and less legal clarity in some cases. Um, and so in a lot of those countries, precious metals and especially gold are very attractive. In Egypt, is generally dollars, gold, and real estate is what people want to own. Um, and so that's true for a lot of places in the world. And so I think that, really ever since 2009, if you look at central bank gold tonnage, it was on a multi-decade decline until 2009, and then it started rising. But gold was in kind of a local bubble in 2010, 2011, and so it had to work through that for a period of time, and eventually it did. And now you still have central bank tonnage accumulation and kind of increasing realization that the U.S. is stuck in fiscal dominance. Um, and so there's kind of a structural bid for gold, structural bid for kind of high quality assets in general. I do think that it, it it's not purely risk on behavior because like a lot of the especially in equity markets a lot of the gains have been in high quality assets, which is the big profitable tech stocks rather than the unprofitable ARC type stocks. um, Similarly, most cryptos haven't really reached new highs. Some of them have, but not most of them. um, Emerging markets continue to not be very attractive to a lot of investors. um, US kind of small cap value. If you kind of look at certain banks or certain industrials, I mean, they're kind of not particularly exciting. Whereas the things that are trading really high are like, ironically, things like Costco. It's like a super blue chip stock, basically bulletproof, but it's trading at over 50 times earnings.
Yeah,
Um,
valuation's high. Yeah.
yeah, they're paying more for that than they are for Nvidia on a PE basis. Um, and that's actually in some ways indicative of risk off because they're saying, I literally don't know what I want to invest in other than Costco at 50 times earnings, right? Um,
Well, the
and so
S&P 500 is also what, isn't that at an all-time high?
well, yeah, but a lot of that is concentrated in those big names. It's the Mag 7, but then also Walmart, Costco, things that are perceived as recession resistant, big liquid, um, high earnings certainty. And that's where a lot of the capital has fled to.
Now, in terms of investable trends, do you think that robotics, cybersecurity, are these investable yet, or do you think that there's not enough companies there that are profitable?
There are, so cybersecurity it's often part of other things. There are some pure play cybersecurity companies. They tend to trade at high valuations, which makes it more challenging. Um, with robotics, I think anything hardware related, it tends to be harder. Um, so, some of the like leading robotics companies of the past 10 years, generally did not have maybe as great returns as you'd expect, either in public or private markets. Um, if someone gets high conviction that their particular solution is the one that's going to take off, um, then that can do well. But in general, I think that robotics are going to, not be as explosive to the upside as AI data centers. So I think basically AI eats white collar work quicker than it will eat blue collar work. That's also because, if you look at processing, um, you know, even though supercomputers have been reaching like, the levels of the human brain in terms of how many computations per second they can do, the energy cost per unit of computation is still high. So like the human brain literally runs off of like 20 watts. It's like less than an incandescent light bulb powers the human brain. Um, whereas any processor that we have that is, as far as we can estimate, is roughly running at the capacity of the human brain takes like orders of magnitude more power than that. And so until we have another big leap in processing that allows that type of computation to exist in very efficient mobile packages. It basically means that our data centers are going to be very powerful for doing human-like tasks. Like allowing one accountant to have a bunch of AI accountant assistants, and therefore dramatically increasing her productivity. Compared to, if you imagine how difficult will it be to make a robot that can drive out to your house and do anything that a handyman could do. Fix drywall, climb up to your attic and fix something, fix an electrical issue. Um, that's really hard to do in terms of processing ability and programming versus, say, accounting or graphic design or certain things like that. And so I think that the bigger opportunities in data centers, and then over time, it increasingly, spreads out into more and more robotics.
Yeah, the parts for the robots are starting to come down a lot, but you're just starting to see in China that the Chinese auto manufacturers are transitioning over to manufacturing quality robots, but I don't think they're profitable yet. They're talking about making what, a $30,000 robot that can do chores in the household. I don't know what their profit margins would be on that. Actually, for artificial intelligence software, I think ChatGPT, well, OpenAI just released that ChatGPT Pro. What, that's the one that's $200 a month. I think they just said that they're losing money. People are using it so much, they like it so much that the energy requirements, they're not even making a profit on that right now. So they're going to probably have to raise the price for ChatGPT Premium.
Yeah, which then starts threatening its growth. Because if you build a business out of selling $20 bills for $10, you're gonna have explosive growth. But then as soon as you charge like the fair value, um, that growth rate slows down. because part of it is you were underpricing all along. Um, and so, I think robotics will probably go a similar way of cell phones, which is at first they're a novelty and something you can do if you're wealthy. And then they have to go through more orders of magnitude of efficiency gains before they become a mass retail product. Um, and so, like those robot dogs, I think they can be great for like security and random tasks and helping things. Um, Especially in another 5+ years. Um, I think little flying drones that can monitor your property when you're not there and do all sorts of stuff like that. I think those types of things are going to catch on. But I mean, we're still at the phase where making a vacuum cleaner robot is non-trivial. Like Roombas don't just work perfectly, right? And that's like task 101 before you can have a robot that can do, 20 different things.
Well, the cost for the LiDAR for the electric vehicles, that's been falling a lot the last 10 years. So as that cost, they improve the quality of the LiDAR manufacturing and the costs come down. They can then put those components, those manufactured parts that used to go into electric vehicles with improving self-driving, they can then put that into robots. But I don't think we're quite there yet. But as that comes over the next 5 or 10 years, that will improve the robotics and the cost will come down.
Yep, and the processing will keep getting better, so you have more computations per unit of electricity, and therefore able to get, more human-like intelligence in that kind of mobile form factor, whereas currently it's more limited to data centers. So yeah, over time, a lot of that can become increasingly more efficient.
I want to ask you about the Trump administration and Republicans in Congress. Do you think that this is going to benefit Bitcoin, the blockchain, innovation for crypto and blockchain technology compared to if the Democrats had actually won the elections?
I think around the margins, yes. I mean, I was bullish before and after the elections. I think the after the elections, Bitcoin got a jump in price that was pretty well deserved because he priced out some risks and he priced in some upside possibilities like a strategic Bitcoin reserve. Um, there's been a flurry of small companies announcing Bitcoin treasuries in a similar way that MicroStrategy did. And there's a couple reasons for that. One was so before the election, the accounting rules updated to make that more favorably treated. So that was a big component. But then also, when you look at the earnings calls or the announcements of some of these companies, they're often citing better regulatory clarity. So the simple fact that they think there's a far less chance in the next 4 years that they get punished for adopting a Bitcoin strategy or treasury uh, makes them more willing to do it. And so around the margins, there are more companies operating with more confidence about it. Um, when you look outside of Bitcoin and in kind of the other cryptocurrencies, they're going to expect a much easier SEC that will loosen and provide more framework for what a crypto security looks like and how to issue one. Um, and so, I think to the extent that that's all happening, that's positive for the space. And so it doesn't change my outlook long term on Bitcoin, but it certainly potentially brings forward some of the gains we might have had over, two cycles into one cycle. But either way, I think a lot of this was structurally going anyway, and it's a global phenomenon, so it matters more than just one country.
Well, I mean, Mark Andreessen has said that like the previous administration, the Biden administration, and Kamala Harris, if she had won, were very hostile towards innovations with smaller artificial intelligence companies or blockchain technology company innovations, and then also American manufacturing. So hopefully we will see a renaissance here where at least like the regulatory, a lot of the higher costs or regulators blocking some investments into factories and, improving more efficiency gains so there's not problems with labor because like I don't know there's a ton of interviews my listeners should just go listen to with Mark Andreessen. He's just going into detail about this, how like the politicians were blocking manufacturing and innovation over the last 4 or 5 years if they want to check that out.
Yeah, I think that's an area that can certainly improve. I think there are also there's still more structural issues impairing some of that. So, for example, the fact that the U.S. has the highest healthcare costs in the world, um, that translates into if you're an employer that wants to figure out where to put a manufacturing facility, every American worker you hire, you're gonna have to pay this like crazy healthcare cost, or at least part of it. And so some of it is regulation, and other parts are a little bit more entrenched. So I think they can fix some of the low-hanging fruit, but there still are some structural headwinds against rapidly reshoring American manufacturing.
So, in terms of bull market, do you think that we're going to see another bull market going forward for gold and Bitcoin and the dollar?
I think gold and Bitcoin, yes. I think they still have room to run in the next couple years. The dollar is a little bit tricky because right now there's a pretty significant long bias in the market toward the dollar. If you look how the dollar performed last time Trump took office, so it rallied after the election and then fell after the inauguration. I'm not sure it'll be quite that clean this time, but in general. It's even possible that some of the trade deals that they will make to maybe not do tariffs as high as they initially talked about will be currency deals. So kind of like how back in 2016 there was speculation around a Shanghai Accord to potentially weaken the dollar. I would not rule out a Mar-a-Lago Accord um, to keep the dollar pretty contained because when the dollar is at levels that it is right now, one of the things that starts happening is that foreign holders of treasuries and U.S. assets begin selling their assets to get dollars to cover their dollar liabilities. And in aggregate, they have a lot more assets than liabilities. Not every country, like Turkey, has more liabilities than assets, whereas other countries are more balanced and other countries have more assets than liabilities. But in general, when the dollar gets too strong, it starts to constrain liquidity and then bounce back into negatively affecting U.S. capital markets. And it's also against what Trump wants to do in terms of trade. And so I think that they'll probably try to keep a lid on the dollar. I don't know if the top's already in, um, but I'm a little bit more mixed about the dollar, especially if I factor out the euro, because I'm bearish on the euro. But if I compare the dollar to Chinese currency or others, um, I'm more neutral in that, whereas I'm more structurally bullish on Bitcoin and gold.
Okay, so if I could summarize what you just said with assets and liabilities, basically the stronger the dollar gets, and we're at 108 on the dollar index, if it goes to 110, 112, 115, 120, God forbid, then that creates a global margin call on the dollar liabilities like dollar denominated debt, dollar derivatives in the over the counter derivatives markets, those types of things. And that's a very big red flag that like there could be a liquidity event, a bank could potentially fail with a margin call or a counterparty risk then.
Yeah, that kind of thing. And even around the margins, like so if you look at so the Fed custodies something like 3 trillion in treasuries for the foreign sector, and they update weekly what the balance is. And this is available on the St. Louis Fed website, um, and other areas. There's already been selling pressure in treasuries in that component that we see every single time there's a dollar spike like this. Um, and so you can start to get higher yields, liquidity can dry up, and then you can start to get, S&P 500, starts to stagnate. Um, in the near term, it can cause market disruptions. And then if it's left to continue for a while, you could start to get liquidity problems in the treasury market. So, for example, back in 2022, when the gilt market blew up, um, the treasury market was actually not far behind. So that's when we had that dollar spike to 114 on the DXY or something like that. Um, at the same time, the U.S. Treasury market was getting fairly liquid. It held up better than the gilt market, but it was running into pretty severe turbulence, and then the broader market was. And then because the U.S. is so financialized, if we have asset prices go sideways to down for a year or more, our tax receipts start to suffer. So the deficit blows out uh, by having too strong of a dollar. So there's multiple like near term, intermediate term, and then longer term effects when the dollar gets too strong. So it breaks certain places faster, like say Turkey, and then other places with more reserves, more assets, they hold up better. But then as that keeps constraining more and more of the globe, some of that ricochets back into our capital markets and starts to impair us, like kind of one step at a time.
So
And we're
then
already
you
kind of like, yeah, we're already in the earlier phases of that.
So then you get a panic event potentially like the Plaza Accord or something like that, where an entire block, like an Asian tiger crisis, because that was related to a dollar rally or other similar problems are in the derivatives market or banks that had bad bets. If the dollar goes off on a rally, then that could potentially crater like in a bunch of emerging markets then.
Well, potentially. I mean, so I think if you have an emergency event, it looks more to some extent what the Treasury did since 2023 was an emergency event. They started for no clear reason. They started issuing a lot more T-bills. And that's what an emerging market does when it has a fiscal issue. They shorten the average duration of their debt. They start issuing near-term paper. And so the global currency reserve issuer started shortening its T-bill issuance. That's one of the ways they got out of that 2022 dollar spike and gilt problem and U.S. Treasury market problem is they started front loading their treasuries. And that only worked because they had $2 trillion in the reverse repo facility that they could basically tap liquidity as long as they issued a bunch of T-bills. Um, so that's kind of near-term stuff they can do. When they do like an accord, you generally need multiple countries to agree, and therefore that's a little bit more time-consuming and strategic. Um, and the emerging markets that break right now tend to be, for the most part, not even like emerging, but like frontier. Like Egypt breaks, and uh, multiple other African countries break. Um,
It
the
would
the
have been
biggest
Argentina before Malaya.
Yeah, so Argentina, they were breaking, and then Turkey is the biggest, Turkey's one, Turkey and Argentina are both G20. So they're some of the biggest ones that broke. Um, but so in general, the bigger countries generally have more reserves this time. So Russia and Brazil and China. India doesn't really have too much of a dollar debt problem. So a lot of the core BRICS countries are better able to withstand that to varying degrees. Obviously China more than Brazil, but it shows up in these little pockets of weakness throughout the world until there's enough of those that it ricochets back into U.S. markets, and that's when the U.S. cares.
Do you think then the goal with the policymakers at the Federal Reserve Bank, Treasury here in Washington, D.C., the goal is to manage the dollar? They don't want it too strong or too weak, kind of keep it range bound then?
I think so, and I think that Trump will probably pay more attention to the dollar than the prior administration. Um, I mean, he's done interviews where he's talked about, like, he'll talk about, you know, uh, Japanese like construction equipment, Komatsu versus, Caterpillar construction equipment. He'll get to that granular detail. Um, and so he's pretty acutely aware of currency differentials for trade because it's one of his priorities. Um, so I think under the prior administration, they handled it when it became an acute issue. This one might handle it even preemptively because they want to use it in negotiations for reshoring and trade deals. So, yeah.
Well, I really enjoyed our discussion today, Lynn. I want to thank you so much for your time. If my listeners want to check out your book or the other social media website that you're working on. What is it called? Grokker or
That's Nostr. So Nostr is an open source social media protocol that a lot of people have contributed to. I've been a big user of it, and I like there's different companies that build on top of it, so people can check that out. And my book is Broken Money. People can find it on Amazon, or they can find me at lynalden.com.